Let's do it. Let's do it. We're going to talk about this idea of the volatility playbook Matt's been discussing here recently, ways to be smart, more controlled in the way that you structure risk in a volatile environment. The options market gives you plenty of choices, and we're going to use the risk graph to kind of illustrate some of the trade-offs and I think, again, a more intelligent way to build either a cash flow trade or a directional trade if you want to play in this more volatile environment. So couple of vocabulary terms that are going to come into play here. You'll hear us talk about open-ended risk graphs, right? Or close down the risk graph, right? We'll talk about fixed risk or minimal low risk, right? These are important concepts to understand because they're terms that are very specific to the options market. You won't really hear a fixed risk you might hear elsewhere, but the risk graph stuff I think is important. So specifically, let's say that with today's improvement, the markets are improving. Again, it's one day, all the disclaimers, but look, it's an improvement. In fact, as we've been talking, the S&P has broken through that short-term resistance zone that we referenced earlier in the show. Here's SPY. If we look at ES, you'll see we're taking out the high. So the point is you have some technical confirmation of improving things. The question then is, how do you want to go about capitalizing on this in light of the volatile backdrop? Okay, if I want to go directional and go for the gusto, I could buy a call option. I could buy a call. And this has an open-ended risk graph. And by open-ended risk graph, we mean it has unlimited reward. Unlimited reward. That is one way you can do a bullish directional trade. And by nature, a long call option is limited risk. It's limited risk, but it can be substantial. So yes, your risk is capped in terms of how much you can lose, but it can be a lot with buying a call option, particularly in a high volatility environment. So if you went into either the market or maybe you pick an individual stock, the reality is there's not a whole lot of fantastic patterns. There's still a lot of volatility here. But just to illustrate the concept, let me use IWM. Okay. If I come in and I buy a call option on this, I'm telling you, volatility is high right now, and these are going to be expensive. So let's say I go to April, okay, and I buy just an at-the-money call option. We're around 205, so I'm going to buy an April 205 call. It's going to cost me about $8. Okay, let's look at the risk graph. It's a hockey stick. Okay, just a classic long call. I have unlimited upside. This is the open-ended risk graph. Okay. Matt uses this term all the time. When a stock breaks resistance, okay, we'll talk about, okay, hey, this is a bullish omen. It's a bullish signal. Time to open up that risk graph, right? If ever there's a time to get more offensive, to turn your trade more bullish, so you have more profit potential. Hey, you could do worse than doing it when we're breaking resistance, right? Well, is this a time that you want to do that? I know we have a little bit of a bullish signal in the market, but look, yeah, the risk side, it is limited, but it's $800, $800. I don't know that I want to face that. And so in this type of market, when volatility is high, when uncertainty and overnight gaps are rampant place, this is the type of time where maybe it's not as important to open up the risk graph, and maybe it's more important to limit the risk and come up with a lower cost way of making a bet. Because I think that a lot of traders in this environment are more focused on minimizing risk, minimizing damage, than they are trying to shoot the lights out and hit a home run. And with a long call option, that is a shoot the lights out, try to hit a home run type of strategy. How do I take this and make it a little bit less aggressive, lower the risk, which might be something more appropriate given the volatility backdrop? It's a very simple adjustment that you can make here. instead of buying a call, okay, the less risky, lower cost, maybe more conservative alternative would be a bull call spread. Instead of buying the 205 call only, why don't you sell a higher strike call against it, maybe a 215 call? These are going to be in the same month. So I bought an April 205. I'm going to sell an April 215. So in the option chain, I just default to do a $10 wide spread, but you can, here's the cool thing about options. You can shrink the spread or widen the spread depending on if you want to get more aggressive or less aggressive. But if I sell the 215, I'm going to reduce my cost by $3.50. Well, $3.50, well, let's call it 340. 340 on 8, I just cut the cost by 43%, which means I cut the risk by 43%. Now, what did I give up? Well, you no longer have that open-ended risk graph, right? So if I go analyze this bull call spread instead of the long call, look, my upside is now capped. But it's substantial. This is a $10 spread. And my upside, if you look at the blue number here, is $529. I can still double my money. Doubling your money hardly qualifies, in my opinion, as a oh, I only doubled my money. Cry me a river. Like, you still made good money here. Come on. So I'm limiting the gain, yes, but it's still substantial. It's still substantial. So long call, open-ended risk graph, shoot the lights out, go for a home run, take $800 of risk. You want something a little more tempered, maybe more appropriate with a volatile backdrop, where you're more concerned about the risk side, and you want to go directional? Bull call spread. I cut your cost and risk by almost half. Yeah, you capped your upside, but let's be honest. How many of us think the market's going to skyrocket in the next couple of weeks anyways, absent volatility? I mean, I think that's the lower probability outcome. So what better time to be willing to cap the upside at 100% gain in exchange for cutting your risk nearly in half? I favor bull calls in the volatility playbook as a logical alternative to long calls. Now, you could do the same thing using the same logic with a cash flow trade. So let's say you're not comfortable enough to go more directional and you want to lean bullish, but do it more in a high probability cash flow kind of way. Well, again, the default here, the simple bullish cash flow play, would be selling a put, right? Sell a put, a naked put. That's the simple way of doing it, is to say, look, vol's high. I want a cash flow play. Small caps are showing some strength. Let me go sell an April naked put. I'm going to go sell me 20 delta. Let's sell a 186 put. I want to use a whole number. Let's sell a 185 put. Actually, maybe those are both whole numbers. I need to go back to math class. I want to use a more round number that's in $5 increments is what I meant to say. But I'm going to call it $3. Well, let's just sell a naked put. Let's get $300. You could do that. You could definitely do that. It's a nice type of risk graph here. But like the long call has an open-ended risk graph to the upside, naked puts have open-ended risk graph to the downside. Like your risk is open-ended. And you may say, hey, my volatility playbook with this as the backdrop, I'm not sure I'm comfortable with that. I don't like the open-ended nature of the risk graphs, particularly on the downside. And so I want to do a cash flow play, but I don't want to take all this open-ended risk. What could I do instead of just selling this 185 naked put for $300? Answer, make it a spread. Same logic as what we did with the long call. So I sold the April 185 put. That's the naked put. I'm just going to buy protection. I'm going to buy an April 175 put. Turns it into a $10 spread. And it cuts the risk dramatically, which cuts the cost dramatically, which probably cuts your emotions and the amount of angst that this trade might deliver to you dramatically. What are you giving up? Profit. You're not going to be able to make as much profit. At 300 bucks you got to give up 180 to buy the insurance. So you're getting $1.32 now. But look at the risk graph. Okay, here you are open-ended with the naked put, lots of potential risk, thousands of dollars. You cap it, sell the bull put, you've got $800 and $870 of risk. Okay, and you've now taken that open-ended risk graph and you have limited, the downside. So this is a technique we use all the time. It's as simple as taking a plain vanilla call, turning it into a call spread, taking a plain naked put, turning it into a put spread. Spreads allow you to better control risk, better control cost, and ultimately play in a volatile environment without maybe feeling like you have these extreme potential outcomes that you may not really want to deal with given the craziness in the market.